Hi there and welcome to the Stock Club podcast. I'm James, and with me this week is Rory, Anne-Marie and Mike from the MyWallSt stock analyst teams. Today, we're talking about the reasons why Amazon buying MGM makes sense, even though acquisitions are generally bad ideas, why companies that pay their employees will tend to be better long-term investments, and how cybersecurity will become one of the mega trends for investors to hop on board in the next decade. So we're all big fans of TikTok here on Stock Club, but Anne-Marie, you shared a video with us a few days ago. It was part of the kind of, I suppose, suspicious FinTwit side of TikTok. I don't know if you can call it FinTwit if it's on TikTok, but it was how to get rich in 3 easy steps. And the steps were as follows. It was steal hotel soap, invest the savings in the S&P 500 and become a millionaire. So when you shared this video with us at the time, you said you had a few questions about it. Have you dug any more in depth on this new investing strategy we seem to have all missed?
I haven't done a lot of research into it. I think my primary concern with this video was the person estimated that people on average were spending $45 a month on soap. And my real question was, what type of soap was he using? Did he think it was beneficial? Should we all be spending $45 a month on soap? It was just very unclear.
Well, Rory, you're from the south side of Dublin, so that's pretty fancy soap. pretty fancy soap. You probably. Well, what's your monthly soap budget?
I don't want to talk about it.
Are we overlooking the fact that your man is also 10 years of age as well, giving finance advice?
Yeah, well, let's not start giving out to people for giving finance advice, seeing as we're on a podcast here right now. So moving on to more, I suppose, pertinent topics. Over the past few weeks, we've seen a rotation away from some of the biggest, best performing stay-at-home growth stocks of 2020. A lot of this movement has kind of centered on more traditional cyclical companies, notably restaurants and retailers, as many people expect them to reopen in the next few weeks and months. However, many of these stores that have been shut down for on and off for the last 12 months are actually finding it very, very hard to get workers back into store. Desperate to capitalize on the customers that are flooding back, major companies like Amazon, Walmart, McDonald's and Chipotle Mexican Grill are all now raising their wages in a bid to meet labour demands. Anne-Marie, I know you've been doing a little bit of research on this. What's going on here? Do you think there's a danger that many of these stores and restaurants just won't be able to open if they can't fill their employee shortages?
I think there's definitely a danger in a lack of employees. I think, number one, it means that locations can't open. And number two, it puts a tremendous amount of strain on the employees that are still within the companies. And that creates not a great work environment for them. And it means that more and more employees are likely to walk off the job.
Yeah.
I think it's definitely something that we're seeing concentrated within the restaurant sector, particularly within fast food. And then we're also seeing it in retail. And I think maybe a bigger question that we should be asking is, I think some people were really quick to place the blame upon the increase in unemployment benefits that the Biden administration introduced in light of the pandemic. And people basically argued, well, if people can make more on unemployment, why would they work a minimum wage job? And I think maybe the better question was, why is our minimum wage not keeping up with what we have determined is the absolute minimum for an unemployment payment during a pandemic? And I think it's just highlighted the complete stagnation of the federal minimum wage in the United States. As a share of gross domestic product, worker compensation is at the lowest point it has been ever in the second half of the 20th century in the United States. And when we calculated inflation, a minimum wage worker today would make less than someone in the 1960s or 70s working on minimum wage.
Wow.
And so it's really less a reflection of, I guess, corporations, and I think more a reflection of how we've allowed the federal minimum wage to sit completely stagnantly, which I would kind of place blame upon the way that the legislation functions in the United States, in that Congress has to pass an increase every couple of years, and it means that it has to get through the House and the Senate, whereas in a lot of other countries that have minimum wage legislation, an impartial committee meets once a year and raises the minimum wage based on things like average salary and inflation. And so I think we're really kind of just catching up with the fact that the wages have sat stagnant and the corporations have taken advantage of the fact that we have a low wage economy. And I don't think people are really going to stand for it anymore, because it really is a poverty wage.
Yeah, absolutely. But I suppose then the other side of the argument, and the argument you often hear from these big companies, is that, rising labor costs will mean that will have a big impact on their bottom line and their margins. Rory, would you be concerned with this?
No.
Right, moving on then.
Done.
Yeah.
No, it's another symbol of this K-shaped recovery that we're starting to see, where people who are, working good jobs, are able to work from home, haven't been as impacted by the pandemic as other people. I think there was something, whereas like if you're earning like $100,000 a year, your opportunity, you've like 80% chances you can work from home. Was if you're earning less than $40,000 a year, there was like a 10% chance you could do that. And there's an awful lot of stuff's going on at the moment. We're seeing like the crazy numbers where restaurants just cannot hire workers, and they're pulling out all sorts of tricks out of the bags. McDonald's is offering like free new iPhones for people just to like come in and do an interview with them, essentially. Like, just start offering decent wages to people. The minimum wage for tip workers is the same as it was 30 years ago. And it's going to impact the economy in a terrible way, because you're not going to have consumers to buy your products. I mean, look, a lot of the companies that we look at, we always like to look at companies that are providing decent living wages. Costco, for example, has been a kind of shining light in this area, where they constantly are raising their minimum wage, paying their employees a decent salary. And they're the companies that people love to go to. They're the companies that get the great reviews on Glassdoor, the companies that people have a real affection for. People love shopping at Costco because they feel they're part of this like good deal, this deal that works out for everyone. And I think it's becoming a much more important element of people's investing philosophy, is this whole ESG, social responsibility thing. There's, consultancies out there that are just being asked, how do we make ourselves look better? How do we put out more PR to say that we're a better company?
Yeah.
Just be a better company. That's
just on the Costco example there.
It.
Costco is famous for paying its employees well above the minimum wage, and from an investor's point of view, then too, it's also been a very good investment. It's up more than 150% in the past 5 years. It's up close to fivefold in the last 10 years. What is the correlation, do you think, between paying employees well and good business performance?
Well, I think kind of people are kind of having a bit of short-term panic in terms of they're thinking in the next year, if all of these companies are forced to raise wages, it means that their expenses will increase and therefore their bottom line or their profitability will decrease. And I think that is a risk for kind of a short-term investor, but I think you really need to be looking in the long term. And I think Costco is an absolutely great case study for that. Costco is like one of my favorite stocks. I think it is my favorite kind of brick and mortar retailer stock. And back in the kind of late 90s and early 2000s, the stock really suffered because they would consistently put out these press releases saying, we're improving our minimum wage, we're increasing the medical insurance that our employees are getting. And it kind of freaked out investors, even though Costco was consistently showing 25% revenue growth year over year. And so investors were just cold on the stock and they weren't interested in it. But their CEO and founder, Jim Senegal, he really did stand firm. And he said, no, if Costco has good working conditions, it will mean that the employees who work there will stay longer and they'll be happier, and that will translate into better customer service, which will translate into more memberships and more sales. And he was right. Costco has higher returns per employee than any other retail player. Their workers stay on average for 9 years, which is tremendous in the retail space.
Yeah, that's incredible.
Which means they have low recruitment costs, they have high retention rates, and they have industry-leading productivity for their employees. And this is because in 2020, their minimum wage was $16 an hour, and more than half of their hourly employees were making more than $25 an hour, and they offer comprehensive health insurance to everyone. But I really do think this is something that has to kind of be established from the top, in that Jim Senegal, he took a pay cut in order to ensure that they had this amount of money to kind of make sure that lower employees are being paid. And he paid all of his executives lower than they probably would have earned at a competing company.
So do you think this is a sea change we're going to see across the wider industry, that more of these, when there's more people working from home in higher paid jobs and more of this labor pressure on the kind of the lower minimum wage jobs, do you think we will see this, or do you think, the blame will just be put elsewhere as we see so often?
I do think it's going to be a change. I really think it'll probably be a generational change. I think millennials and members of Gen Z are much better at being aware of kind of company practices. I think they're much better at recognizing the fact that a CEO makes hundreds of billions of dollars doesn't necessarily mean that a company is great or that you should be supporting it. I think part of the reason people like Costco is because it is a known fact that their employees are paid very well. And I think it means that you have an easier time going there and spending money.
Moving on then, there's been two big bits of merger and acquisition news recently. The first one is AT&T and Discovery, who have entered into a media merger deal to create a new streaming giant that's reportedly worth upwards of $150 billion. This will see the likes of CNN, HBO, and Warner Brothers combined with the Discovery Channel Animal Planet. The other piece of M&A news confirmed just before we started recording today is that Amazon is set to buy MGM Studios for just under $9 billion. This is the second largest acquisition that Amazon has ever made, just behind Whole Foods. MGM is well known for its repertoire of classic movie titles, but probably most relevantly and most recently also the James Bond franchise. Rory, with these two massive kind of deals, one a merger deal, one an acquisition deal, which has caught your attention most?
Well, earlier this week I wrote a Daily Insight in which I said the Amazon deal probably wasn't going to happen because Amazon management are traditionally like have a zero tolerance policy on leaks. So if you hear about a deal leaking, like that usually means the deal's off.
So would you say you were wrong, Rory?
I just can't believe Jeff did me dirty like that.
It's in his new role. He's moved away from the CEO.
Yeah, he's gone.
He's not looking after you anymore, Rory.
Oh, maybe the deal was agreed beforehand, or maybe, I don't know, maybe this is the exception that proves the rule. Anyway, as you said, the deal's going ahead. They're getting 4,000 films, 17,000 TV shows. Like you mentioned, Bond is obviously the big kind of draw, but they've also got some good TV content like Fargo and The Handmaid's Tale.
Yeah.
But yeah, it comes a week from when we heard AT&T was essentially abandoning its ill-advised soiree into the contents world. They're spinning off their Warner Media division, previously Time Warner. That includes HBO, TNT, CNN, and all the kind of Warner Bros. Film and TV IP. And yeah, combining it with the Discovery Channel, which everyone knows from the namesake Discovery Channel, as well as HGTV, which is primarily focused on reality programming like the Food Network and the DIY Channel. And I mean, it never made any sense for AT&T to acquire Time Warner.
Yeah.
These were two businesses that have totally opposite goals. AT&T, what they want to lock in subscribers in this zero-sum game they've got going with Verizon and T-Mobile. Whereas Time Warner wants to create content and monetize it as broadly as possible. So content's kind of like software. You spend a lot of money creating it and then you try and get it out to as many people as possible because it's zero marginal cost.
Yeah.
It doesn't matter to you whether someone watches, whether 10 people watch it or whether 10 million people watch it. So try and get 10 million people to watch it. So trying to lock it away behind, an AT&T subscription just never seemed to make sense. I think AT&T here kind of fell for the classic plastic surgeon trap, which is something Aswath Damodaran says is always a big problem with M&A deals. They're always fueled by investment bankers.
Yeah.
In the way plastic surgery is fueled by plastic surgeons. You never walk into a plastic surgeon's office and he says, you're perfect. You need nothing. Yeah. Don't. You're perfect just the way you are.
Speak for yourself, Rory. But
investment
on that point, like content became the real buzzword there for a few years. Everything was moving into content. There was rumors about Apple moving. Well, I suppose Apple did move into content kind of with Apple TV. Amazon obviously has their content arm. It seemed like every kind of big tech company was just kind of strapping on a content arm.
Yeah, but tech companies are kind of able to do that. Going back to the plastic surgery analogy, like AT&T was this old world cash generating utility that was went in, investment banker says, we can make you young again. Have you heard about this thing called content? It's the next big thing. It's big. And they paid an arm and a leg, $84 billion to get in this content thing. It actually reminds me, if you've ever watched Succession, it's the Volter deal in Succession. The part where he goes in and he's wearing like the high tops.
Yeah.
That's pretty much what's going on. But then counter to that, right? So Amazon is now buying exclusive content. So why is one deal a good deal and the other deal a bad deal? Well, first of all, Amazon Prime is already in 200 million households worldwide. So I don't think the comparison is quite the same. They're not hiding away content. The vast majority of people have Amazon Prime.
Yeah, they already have the reach.
Yeah, they already have the reach. Essentially, they're just adding on more stuff into their kind of massive distribution. It's also not a zero-sum game. Like you look at something like, I would assume just by looking at the numbers, most households in the US already have both Prime and Netflix and potentially Disney Plus. Even adding all those up, it's still nothing compared to your traditional cable bill. I'm also not entirely sure or sold on this idea that Prime Video is a retention tool. It's certainly kind of a nice benefit, but my theory on Prime Video is that it actually acts as an enticement for customers who aren't able to reap the full benefits of Prime.
Yeah.
So there's plenty of places out there where Amazon doesn't have the infrastructure yet to do the whole 2-day delivery, or where there's not as much selection in terms of goods that are available through Prime. So places like Ireland, for example, where we are, they've got some differentiated content. If there's a particular box set you want to binge on, or some sort of Hollywood winning movie you want to see, it's only available on Amazon. So, you sign up for a subscription for a month. And then meanwhile, during that month, there's something you need to buy. You go on Amazon, you realize it's on Prime. It's not going to be 2-day delivery, but it's going to be a few days, and it's going to be free. And the next thing you wake up on the floor of your apartment surrounded by recipe books you don't need, and wondering how you got there. I'm talking from experience.
I was meant to say again, Rory, speak for yourself.
Yeah. So that's where I think the difference is between these two deals. And Amazon spent, I think it was 11 billion last year on content alone. Yeah. So this is such a drop in the bucket for them, even though it's the second biggest acquisition they've ever made.
Speaking more broadly then, we've spoken about this before, that how, although they're quite exciting to hear about, and especially if you're a shareholder in the company, mergers and acquisitions are more often than not terrible for shareholders. Can you explain that a little bit more, Rory? Why do most mergers and acquisitions just not work out?
Well, yeah, so this goes back to a Harvard Business Review article that was published in 2011. Clayton Christensen, I think, was the main author, but he was helped by others. They discovered that something like 70% and 90% of mergers and acquisitions end up being failures. It kind of goes into that, yet they still persist to this day. We're on a record this year for deals already. I think it's 1.4 trillion, Bloomberg reported yesterday. And, I'm not going to quote the entire article. I think people can go and read it themselves if they want to. But essentially, you need to look at each acquisition with kind of, new eyes, fresh eyes, and go, what exactly are they doing here?
Yeah.
Is it some sort of like tuck-in or bolt-in acquisition that's going to leverage another company's business model? Or are they just buying customers? And that's what you really need to look at. Not every investor seems to get really excited when they hear a company that they're invested in is acquiring someone, because they get the sense that, if they're spending hundreds of millions of dollars, things must be good. They must be, they're out there, they're making deals. It isn't always the case. In fact, very rarely it is the case. And we've seen in the past, I think of Eventbrite's acquisition of Ticketfly, that was so damaging for the business. Whereas you look like a company like PayPal or Twilio or Salesforce seem to have very, very good track records in terms of their acquisition strategy, and are able to, bring in those companies and help them grow out their businesses. It's really one of those things where you do need to look at each acquisition separately and kind of judge for yourself, and use management's previous track record as a kind of judge as well. Because an awful lot of managers go out and try and buy growth.
Well, if we're going by track record, I'll assume then that you think that the AT&T Discovery one is a bit of a disaster waiting to happen.
Well, I mean, it's at least they're getting out of what was a bad deal in the first place. Because now, I actually think AT&T can go back to focusing on what they're actually good at, and Time Warner and Discovery could potentially become a kind of third player in this streaming market. There's an awful lot of ifs and buts there, because HBO has a lot of its international content tied up for the next few years, but at least they have like a complete package that they could potentially use as an alternative to the Netflix Disney kind of duopoly that's there at the moment.
Absolutely. Let's move on then, and I suppose dominating the news outside of the stock market has been all of the cyber attacks and hacks that have happened recently. So at the start of this month, the Colonial Pipeline system, which supplies most of fuel and gas supplies to the east coast of America, was almost completely paralysed due to a cyber attack. Here in Ireland, our public health service, known as the HSE, was also the victim of a massive cyber attack recently, as patient records and other sensitive data was held ransom for a $20 million price tag. The group behind that attack, Conti Ransomware, have been identified as FBI has been involved in at least 16 attacks targeting US healthcare and first responder networks, and more than 400 organizations globally have been targeted by Conti too. Mike, with so many organizations working remotely and many companies never returning to the office or never fully returning to the office, the issue of cybercrime is only going to become more profound. And I suppose the inverse of that is that there's a massive opportunity for cybersecurity companies. I know you've been looking a lot into cybersecurity as a major trend in the next decade for workplaces. What are your thoughts on the current landscape?
Yeah, I mean, the last few weeks have shown that cybersecurity measures have now become mission critical for organizations across the globe. Do you know, it wasn't too long ago we were talking about the SolarWinds attack too as well.
Yeah.
So I dug up some stats here. So, according to the Center for Strategic and International Studies, the global cost of cybercrime is going to be about $1 trillion annually.
Yeah.
And IBM estimates that the average cost of data breach is about $4 million. PwC did a survey on CEOs and they put cybercrime and data privacy second among 11 areas of impact and value. So
yeah,
there's going to be huge amounts of spending here from enterprises across the globe.
Yeah, it's no longer a case of, locking the front door in many of these businesses. Like there's multiple front doors into the really sensitive data in these companies, and it's on every single employee's laptop.
Yeah, absolutely. And I think you described there the intricacies and the nuances of the industry, where there's so many smaller companies that provide niche products and services. It's not enough to just go in, read through a 10K and a few earnings reports and get a sense of the company and its competitors. You kind of have to do a lot of heavy lifting. And I found it myself, without the technical knowledge to fully identify the business needs and distinguish and benchmark competitors, quite a difficult industry look at from an analysis perspective. What's the difference? Well, is endpoint security more important than access management, or why does this company command a higher multiple if they both have similar numbers?
Yeah.
So I think, Rory, you discussed this before. It's very important to expand your circle of competence. Cybersecurity is definitely one of those areas where if you want to invest in these companies, you have to educate yourself further on the industry as a whole, the hierarchy of security needs businesses will have. So and
as you mentioned, Mike, Rory, you've spoken about this at length, and I know, for example, in MyWallSt, we have one major way to expose yourself to cyber security, which is the Hack ETF, which is obviously an ETF of lots of different cybersecurity companies. Is it a case that the field is just too fragmented to be able to invest in one or two companies and get broad exposure?
I'm not sure if it's too. I mean, it is massively fragmented, and I think one of the main things with cybersecurity companies is like their main thing that they sell is the one biggest weakness that they have, because all you need is one news article where one thing that they predict gets hacked, and suddenly their reputation is damaged.
Yeah.
When we look back at cybersecurity companies years ago, it did become one of those questions or those just decisions where it was like, we're outside our circle of competence here. We don't have the technical know-how to judge which company has an edge. And everyone we talked to said something different. But yeah, I mean, look, it's becoming a huge thing. I don't know if any of you have noticed it, but I'm being scammed on a regular basis now. I'm too scared to answer my phone. I don't respond to any text messages. I don't even know if you are who you say you are right now. That's how paranoid I am. So there's so many different areas to look at. Zero trust networking was one that I've become particularly interested in over the last few months. We talk about companies like Cloudflare and CrowdStrike, and another one called Okta that seems to be really involved in this space. But again, it's one of those areas where if you don't have a kind of edge, you're really kind of relying on someone else to kind of explain it to you and know what's going to be the best investment out there.
Absolutely. Mike, any companies that you're looking at?
Yeah, so I looked at a few there and came across the similar difficulties as Rory in that it's tough to distinguish the edge. But there was Verona Systems, Tenable, KnowBe4, which provides security training. There's a few interesting companies out there, all with about a $5 billion market cap.
Yeah, absolutely. I'm just thinking now that we're definitely going to have Emmett on the next episode telling his story about being hacked again. I think he's told it multiple times in this podcast. Emmett, if you're listening, I'm sorry you're not here for this one. It's perfect.
He's gonna throw in Tom Hanks now as well, just to punish you for calling him out.
He's going to be like a bull on the next one that we're talking about him now, and he has no chance to respond. So let's move on and take a quick look in to see what's going on in MyWallSt at the moment. It's the end of May, so that means our Stock of the Month report, our exclusive Stock of the Month podcast are both live in the MyWallSt app now. We've also added our brand new stock to the shortlist last week. This is a company that's defined the SaaS business model as we know it and can give your portfolio some much needed stability in these very volatile times. I'm also really excited to say that we have a brand new podcast series launching in the next few weeks. Get Started, the Beginner's Guide to the Stock Market, is a 5-part series that's been designed to give would-be investors all the information they need to just get started. Based on the lessons from MyWallSt's Learn app, which has been downloaded millions of times globally to date, Get Started covers everything from why long-term investing has been proven time and time again to be the best wealth creation strategy to the things we look for in finding great companies. Rory, me and you sat down, I think it was actually this day last week, and we recorded all 5 of these episodes in one go. What would you say about the Get Started series?
I'd say it's the hardest I've ever worked. At the end of the day, I was like tired. I was like, "What is this? What a full day's work feels like?" Because if so, sign me out.
So it sounds like we're not going to get any more of these series based on Rory's assessment of it there. So you better keep an eye out for that series, which will be launched next week. Jargon Busters. So we've 2 questions this week. Mike, the first question is over to you, and this comes from David in New Zealand. He got in touch with us through Twitter, and he was talking about how the All Blacks, which are New Zealand's national rugby team and are widely considered as the most successful sports team in any sport ever, they're selling a 12.5% stake in the team to Silver Lake for reportedly close to $400 million. David wanted to know if it would be possible to invest in All Blacks should Silver Lake acquire part of the team, and more broadly, are there any other publicly listed sports teams that we're interested in?
Yeah, so unless you've got a pretty heavy checkbook, I don't think you'd be able to invest in Silver Lake. It's on the private markets.
Yeah.
But it was interesting because this question came in, and then in the same week, Oak Tree Capital just acquired a significant stake in Inter Milan as well.
Yeah.
So there's clearly an interest here from the big private equity firms to go after these sports teams. And for good reason as well. There's Jerry Jones famously bought the Dallas Cowboys for $150 million in 1989. It's worth about $6 billion now. And even the SPAC king Chamath put $25 million into the Golden State Warriors in 2010. It's now worth about $500 million.
Wow.
So the unfortunate thing for me or you, and I'm not sure if the listener is the same
David.
boat, is that all these deals were on the private markets.
Yeah.
So, it's not the same opportunities as on the public markets. I did a bit of research here. We have Man United, Juventus, Borussia Dortmund, Roma, the New York Knicks, the Atlanta Braves, and the Toronto Blue Jays are all publicly traded in some way. There's also Green Bay Packers Inc., which fans can buy stock in, but it can't be traded, pays no dividends, and doesn't appreciate in value. So
yeah.
Sign me up. That's what I want.
Put a SPAC on that. Anne-Marie, you'd mentioned this Green Bay Packers thing and how the fans are so passionate about this company that they're investing in these stocks they've no real hope of any return on.
Yeah, and I think it's considered, I think, the magic of the Green Bay Packers is that it's fan owned. It's the only NFL team that is fan owned and is kind of owned by the public, and it's helped keep Green Bay in Wisconsin in a relatively small city, really, for an NFL team, and it's kept them in Lambeau Field, which is kind of a famous field for the NFL, but it's like the least sophisticated stadium. And yeah, I think fans just buy it because they love the Green Bay Packers. Like, they get a little stock certificate, they frame it, they hang it up, and it just makes them feel closer to the team. But yeah, no, they don't really reap any kind of monetary benefit from it.
Yeah.
Yeah, I think it's considered merchandise as much as anything. But,
yeah.
Man United's a public company, and I mean, I'm a fan. I'd never buy the stock.
No, and it's a good point you made as well, because there's kind of an intrinsic conflict between the commercial side of a football team and a sporting side of a team. Like, if you consider, I looked it up, the European Super League would have added $12.7 billion collectively to the 12 founding clubs of it.
Yeah.
And you saw the fans' reaction to it. And it's that kind of turning the fan into a customer, which is good for business, but goes against everything you know from supporting a club.
Yeah, absolutely. Yeah, it's definitely a conflict of interest there. I was going to say you would never see people supporting companies like that, but then there's the few Apple fanboys in MyWallSt who maybe make my argument null and void there.
Alejandro and Jamie will be getting a shout out here,
yeah. Not to name any names. We'll have to redact that. Let's move on to the next question then. And Rory, I'm throwing this over to you. This comes in from Stefan, who emailed us in at pod@mywallstreet.com. He asked about our perspective on metrics like return on equity or returns on capital, and how much emphasis we put on them when we're assessing a potential stock for MyWallSt.
It really depends on the company. ROE, return on equity, is an insightful metric when you're measuring. It's kind of a measurement of how efficient a company is at generating profits. There's a couple of different ways people calculate it, but I think the most typical is you divide net income by shareholder equity.
Yeah.
So, breaking it down, let's say I have a company that only does one thing. It just owns one building that's worth 10 million and it has a $9 million loan on that building. So that means the equity in the company is 1 million, and let's say generates $200,000 in rent a year. That means you have a 20% return on equity.
Okay.
Now, since profit is one of the inputs, you can't use ROA to measure unprofitable companies, and it's certainly not suitable for companies that are in high growth mode, since profitability isn't the key consideration there. It's a much more valuable input for companies that are kind of mature, cash generating businesses. Brian Foreman is kind of notorious, brilliant, consistently high ROE business because management are kind of constantly reevaluating their business and discontinuing or selling off any underperforming segments or brands.
Yeah. And just from that point, does it sound like ROE can be a negative sometimes for a company if they focus too much on it? They maybe, cast off brands or portfolios that aren't performing in the short term.
Yeah, potentially. I mean, potentially it could be something that they overfocus on when they don't give something, a chance to kind of take off or to build out something. But it definitely is kind of one of those things that you would never use for a company that is a rapid grower.
Yeah.
I think the example there was like Viva is very high ROE and Shopify doesn't. Viva is just like this cash generating machine that can continue to grow even though it's generating huge profits, where Shopify is kind of foregoing profits right now in order to grow. So the comparison doesn't work. Like all of them, like any kind of valuation metric, you use it as a tool, as part of a kind of broader arsenal of tools. You don't rely on it as that's the only thing you look at. You have to consider what industry they're in. You got to consider what life cycle the company's in. So yeah, it's one of those things. Always do take a look at it if you can. Figure it out yourself. Don't rely, by the way, on Yahoo Finance to figure it out for you, because they consistently get it wrong. You really do need to get into the balance sheet yourself and work it out. But don't use it as a kind of one-stop shop for whether something's a good investment or not.
Okay, cool. Thanks for that. So let's move on to the elevator pitch to finish out today's show. So earlier this week, CNBC published their annual Disruptor 50 list. This is a collection of 50 private companies that have been identified as the next generation of great public companies by a panel of leading thinkers in the field of innovation and entrepreneurship from around the world. If we go back to the first list in 2013, for example, they identified private companies like Airbnb, Atlassian, Etsy, Pinterest, Palantir, Shopify, Spotify, Square, and Twilio as private companies that could disrupt the public market. Of course, they also picked some companies like Aero and Nebula that later went bankrupt, so you can't win them all. But in general, they seem to have a pretty good hit rate. So for this week's elevator pitch, I asked the three of you to review the list of 50 companies they picked this year and pick one company from it to pitch to me. So remember, these are private companies, but company that you can see coming to the public markets in the next few years and causing a bit of a stir. Anne-Marie, I'll go to you first.
I am pitching number 48 on the list, which is Patreon. I really, really like Patreon. It's a membership platform that provides business tools for content creators to run a subscription service. And I think that this is something that's kind of going to become more and more common. I think people are growing accustomed to the idea that if you really like something, if you really like content or you really like an artist, you need to pay money to help support them so that they can continue to do this as their job. I think it's something that we're beginning to see become really popular with paid newsletters, which is a space that Twitter is trying to get into. This is basically a play for all types of content, whether that be, YouTube videos or articles or even like painters and animators use it. And so I really like the company from that. I also really like their CEO. His name is Jack Conte. I was accidentally ended up subscribing to him on YouTube several years ago before I knew who he was. He has a band and he's a musician, and he started the company because he needed a way to help people help support him. And on his YouTube channel, he's really great about, he posts a video once a week, and it's usually him just sitting in his garage or in his music studio, and it's him walking people through the decisions he's made that week for the company, why he's done it, and for what reason, and where he sees the company going. Yeah. So for example, last month they raised $150 million. They went through a round of funding, and then he put up a 10-minute video where he was like, this is what we're going to do with it. Here's how we raise the money. And here's where we see the company in the next 5 years. And I think that level of transparency is really nice to see. And I think it's a great reflection on the product as well, because it's that idea of being open with people and supporting them.
Yeah, absolutely.
Did he say Patreon raise money on Patreon?
I don't think he said that exactly, but that is a missed opportunity.
Yeah.
We should start a Patreon, James, you and me. Start our own Patreon.
Break away, Rory, like we've always planned. Go on, Rory, you can give me your pitch next.
My pitch for us breaking away, or my pitch for CNBC?
Go with the CNBC one. We'll keep that other one private.
All right, okay. Yeah, look, I didn't read all 50 of them, to be quite honest with you.
That's a good start.
I mean, the obvious one, the obvious one would be going with Stripe, our neighbours around the corner, whose business I've waxed lyrical about many times before, who, I really love those guys. I'll stay in the same space, but drift a bit and say, Plaid looks like a really interesting business. It's a company that helps customers link their bank accounts to third-party apps like Venmo and Robinhood and Coinbase, and even our selected brokerage partner, I think, is connected through Plaid.
Yep.
It also has kind of budgeting tools and analytics to help people track their spending. It integrates with more than 11,000 banks and has 200 million customer accounts. It was the big story last year was that Visa was going to acquire it for about $5.5 billion. Thankfully, the DOJ blocked that, which I think is great news for investors, because I do think it'll be a very interesting standalone company and one I'd love to be able to own in the future.
Cool. I buy that. Mike, what company are you pitching?
Yeah, I picked Marqeta because I recognized it from Twitter about a week before I saw this list.
Guys, when you don't put effort into the research, you're not supposed to say it on air.
It's like a disclaimer.
Yeah.
They can't come back at us.
But it's a digital and contactless payments processor. Just filed to go public last week. So there's an S1 out there somewhere.
Yeah.
Customers include DoorDash, Uber, Affirm, and a Power Squares debit card for businesses, and its Cash App. It's growing revenue at like 123%, I think. And in the last year, so it got valued at $4.3 billion. That's last cash raise. In the private markets, it's trading for about $16 billion recently. So there's a lot of hype about this one. I'm sure we'll have another nut job IPO in the weeks to come.
Yeah, that's it, that you can't touch the shares for anywhere near the IPO price. So that's it from this week's Stock Club. Don't forget about all the great new stuff in MyWallSt at the moment. If there's anything you want us to discuss or explain in the next episode, make sure to get in touch. You'll find us as always on Twitter, that's at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club, and if you're enjoying the podcast, please leave a review or a rating for us on whatever platform you listen to us on. That's it from us here today. We'll talk to you in 2 weeks. Happy investing.